The draft legislation for the revised Division 296 tax was released just before Christmas. It confirmed what had previously been announced and commenced a consultation process with relevant stakeholders. Mark Ellem from Accurium joins me now to talk about this development. Hi, Mark. Thanks for your time today.
No problem, Darren. Happy New Year and happy Division 296 version 2.0.
Is that a happy way to bring in the new year, is it?
Oh, I don't know. I don't think it was a happy way to end the year.
No.
Being that last day before everyone shut down, we all were winding down, getting ready for some rest, relaxation, and festivities. To have that drop on the Friday morning.
Yes, yes, tremendous timing. So, why don't we start by just recapping and walking through what some of the revisions were?
Well, as we know, a lot of the revisions were announced back on 13 October last year by the Federal Treasurer. That included the indexation of the thresholds, bringing that in. It includes two thresholds now, a large $3 million threshold and what I think is referred to as a very large $10 million threshold with different tax rates for the amounts over the very large 10 million. So, we've got our 15% additional tax if for earnings attributable to portion of total super balance over 3 million. That is increased by a further 10% to 25% for the amount above $10 million. So we've got, headline total tax rates applying to earnings on super of now 15% below 3 million, 30% for between 3 and up to 10 million, and 40% above $10 million for that amount of earnings. So that was not, well, that was expected because that was announced back on 13 October. We've also seen the change to the calculation or the determination of superannuation earnings. It's more aligned to our taxable income concepts. So that gets rid of that controversial taxation of unrealised gains aspect of the proposal of the measure. That was very welcome to see. That's raised some other issues, which I'm sure will be fleshed out in the consultation process. But yeah, they were the two highlighted areas of the changes that we saw in the revised bill.
Okay, well, you just mentioned the consultation process, which we're in the middle of right now. What do you think, or what issues do you think will be raised during that whole process?
Okay, so I would see it from two aspects there, Darren. First, I think there's a lot of the consultation process may be focused from the APRA funds perspective. They've got some different methodology that they will be applying, and a lot of that is we won't know until it comes out in regulations. Like the bill itself is not the be all and end all of the rules. There's a whole heap of it's going to be in regulations that are yet to come out. The other thing is, the other things that might be raised from a consultation process, particularly from an SMSF perspective, is new things that were in the revised bill that weren't announced back on 13 October. And one of those is it's no longer simply your total super balance at 30 June that determines whether you're an in-scope person. It's now going to be the higher of your TSB at the start of the income year or at the end of the income year. So, one of those strategies that have been talked about the last couple of years when the original bill came out, and, that was a couple of years ago it came out, was that you could get, where you could take money out of super, where you had benefits that you could withdraw from superannuation. If you withdrew enough benefits to get below the $3 million, which was the single threshold we originally had, by the 30th of June, then you wouldn't have any Division 296 tax liability for that year. So depending on whether it was the first year, a second, or a subsequent year, you decided I've had enough of this Div 296 tax business, I want out. You take the money out before 30 June, no Div 296 tax. Well, obviously Treasury and the government's cottoned onto that strategy, and they've put in place this what they call integrity design measure to say, well, no, we're now going to look at your TSB at the start of the year and at the end of the year, and we're going to use the higher of the two to determine whether you're an in-scope member. So if you start at the beginning of the year at more than 3 million, you're in, even though at the end of the year, you might drop below. So this idea of selling up and pulling out your benefits before 30 June to avoid Division 296 tax is not going to work going forward under this new measure. However, I will make the point, though, that in the first year, the transitional year 26-27, they will be only looking at your TSB at 30 June 2027 and not at the start of the year, at 30 June 2026. So it does provide an opportunity in that first year of operation of this new measure, the revised measure, that if you don't want to be subject to Division 296 and you have the ability to withdraw benefits, you could get those benefits out before 30 June 2027, such that your TSB is below 3 million and you wouldn't have Division 296 tax liability of that first year. So yeah, that was something that we didn't, maybe we expected or we're not surprised by it, but it wasn't announced in 13 October. The other thing that gives rise to is under the original bill, there was accepted persons, so child recipients of superannuation pensions and members who had structured settlement contributions. There was also this situation where the superannuation earnings wouldn't be subject to Division 296 in relation to a member who died before the end of the financial year. Now, there was that issue about, but what if you died on 30 June? You didn't avoid it, but that's now no longer an exception because of the integrity measure where they're looking at the higher and lower, that if you pass away during the year and your starting TSB was greater than $3 million, then you're going to have a Division 296 liability. So it'll effectively be raised to your estate. So that'll be, I think, part of the consultation process as well, because the bill, the Division 296 assessment will be raised obviously after the member has died. It will be effectively issued to the estate, because keep in mind, Division 296 tax is a tax on the individual, not on the fund. So it'll be issued to the estate. I assume the estate won't have the option to elect for the fund to pay it. So it'll come out of the estate assets. So that gives rise to the issue, well, hang on, what if the super was all being paid to the beneficiary A over here, and the estate is going to other beneficiaries over here, and it's the Division 296 bill is going to be paid out of the estate assets, not the super, and it relates to the super. So, there's a couple of issues there as well. And just a reminder that if you did pass, or if the member did pass away in the first transitional year, then there would be no Division 296 tax because they're only looking at 30 June 2027. So they're probably a couple of the areas from an SMSF perspective that the consultation process. Those who are back in time, of course, Darren, before the close date on 16 January to make a submission.
Yes. Quite a few quirks there, actually, Mark, that probably hasn't garnered a lot of attention so far. So it would be interesting to see how that all plays out. You mentioned a lot of the focus might be on public offer funds, APRA regulated funds. So does that mean that we can conclude that SMSFs are well placed to manage the new version of this tax?
Well, I think what we've ended up with is what we've effectively asked for. We prosecuted the argument that the original methodology to calculate superannuation earnings was not fair and equitable. This change in total super balance with some adjustments for contributions and withdrawals effectively meant taxation of unrealised gains. And for an SMSF, we prepare the tax return, or accountants, administrators prepare the tax return. So why not base it on taxable income, which is what they've done in this revised version. It's based on the fund's taxable income with various adjustments, for example, adding back exempt current pension income, not adding back assessable contributions, and of course, non-arm's length income, because that's already taxed at top marginal rate. So, it's because it's based on taxable income, and also from the capital gains perspective for small superannuation funds, which of course an SMSF is, that there's going to be special rules to ensure that only the post 30 June 2026 capital gain on the disposal of an asset is included. I think SMSFs are going to be well placed to administer or to address the revised version of this bill. But of course, it has effectively shifted the burden, the administrative and compliance burden of calculating the Division 296 superannuation earnings for the fund and attributing those Division 296 super earnings to the members of the fund. They've shifted that burden back to the SMSF trustees, or probably more correctly, the SMSF accountant or administrator.
Yeah, you make a good point there. So, just to conclude, I suppose, regardless of the outcomes of the consultation process and how the final sort of version will drop, it will mean more administration obligations for SMSFs, won't it?
Oh, absolutely. Yes, yes, that burden has been shifted back to the SMSF itself, so the administrator, the accountant. So, and you think of it, that's, it's a balancing act. You have a simple methodology like version 1 was, where it was movement and TSB, and the ATO calculated it. Simple, less administrative and compliance costs and burden there, but you end up with those varying outcomes, effectively taxation of unrealised gains, but also the effect of unrealised losses. You go to a methodology which is probably more fair and reasonable because it's based on income tax concepts, and there's simply going to be more work involved in order to calculate the amount and report it to the ATO, so the ATO can then calculate the Division 296 liability for those in-scope members.
Okay, that's great. Thanks for sharing those thoughts with us, Mark.
My pleasure, Darren.
Mark will be discussing this subject further at the SMSF Professionals Day 2026, co-hosted by Self-Managed Super and Accurium. It's a three-city roadshow starting in Sydney on the 19th of May and concluding in Brisbane on the 25th of May. There will also be an online component. To find out more about the event and register, please reference the details you can see on your screen right now. Great to see you as usual, Mark, and I look forward to further developments on this topic that will be covered at the SMSF Professionals Day.
Thanks, Darren. We're certainly off to a fast start for 2026, that's for sure.